And you are going to see a crack in the bond market. Okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic.
You've probably heard it a million times. U.S. Treasury bonds are the safest investment around, right? Well, maybe not anymore. Lately, some pretty big names in finance are starting to get nervous. They're seeing signs most people are missing, and they're warning that the bond market might be heading for real trouble. Let's break down what's going on and what it means for your wallet. In 2025, the United States is projected to allocate approximately $952 billion toward interest payments on its national debt, a figure that now exceeds the $859 billion designated for defense. This shift in federal spending priorities is not just a fiscal anomaly, it points to more profound structural problems. The central issue is trust. U.S. government bonds form a critical pillar in both global finance and retirement systems, with foreign governments and institutions holding trillions in treasuries under the assumption they are virtually risk-free. But if confidence in these assets falters, the resulting shock could ripple throughout the global economy. Warning signs are already visible. Interest rates have been steadily climbing, and investor sentiment is showing signs of strain. These aren't fringe concerns. Prominent figures in the financial sector are issuing increasingly urgent alerts. Among them is JP Morgan Chase CEO Jamie Dimon, who oversees a $4 trillion financial institution. Dimon stated bluntly, "We are going to see a crack in the bond market. It's going to happen. I just don't know if it's in 6 months or 6." His remarks underscore the gravity of the situation, especially considering the nation's debt level now exceeds $36.6 trillion, amounting to 124% of U.S. GDP. By contrast, during the 2008 financial crisis, the debt-to-GDP ratio stood at 68%. Financial strategist Lynn Alden also pointed to market behaviors that reflect deeper problems. When stocks are down, bonds are down, yields are up, the dollar is down, and gold is up. That's like the market betting against the U.S. In essence, the global investor class appears to be looking elsewhere for safety. Exacerbating the issue is the country's current $1.9 trillion annual budget deficit, roughly 6.2% of GDP. According to Dimon, much of this can be traced back to aggressive COVID-era spending policies. He warns that a decline in faith in U.S. bonds could lead to a rise in borrowing costs across the economy, impacting everything from mortgage rates to business financing and weakening the dollar further. These dynamics are already playing out in the markets. In May, yields on 30-year Treasury bonds increased by 0.25 percentage points, the sharpest rise since December. The 10-year yield has reached 4.51%, a stark contrast to its sub-1% level in 2020. Such jumps in yield indicate that investors now demand higher returns to offset perceived risk. But Dimon sees the challenge as broader than financial markets alone. He identifies several structural weaknesses, including outdated permitting systems, a broken tax framework, rising healthcare expenditures, and lagging education investments that are eroding national competitiveness. He also criticizes speculative trends like cryptocurrency and advocates instead for strategic investment in industries like defense technology and rare earth minerals. His emphasis on rare earths is strategic. China has a commanding presence in this market and, in 2024, limited exports of key minerals like gallium and germanium, materials essential for high-tech weaponry, signaling its readiness to weaponize supply chains. Beyond resources, China has developed the world's largest navy by ship count, leads in drone warfare, dominates 5G infrastructure, and is expanding its digital influence across emerging markets via its Digital Silk Road. Although Treasury Secretary Scott Bessent has pushed back on Dimon's more dire predictions, highlighting past forecasts that did not materialize, there remains considerable concern about waning domestic and international demand for U.S. debt. Many banks and pension funds are approaching the limits of their capacity to absorb more government bonds. Should buyers continue to retreat, the U.S. may be forced to offer even higher interest rates to attract capital, further inflating debt servicing costs and compounding the challenge. This could set off a damaging feedback loop: rising rates, increased deficits, and further erosion of confidence. Diamond warns that if global investors lose trust in America's fiscal stability, the country's role as the world's financial anchor could be imperiled. A weaker dollar and higher borrowing costs might eventually force cuts to defense spending and foreign aid, reducing American influence abroad. Despite these threats, Washington has yet to demonstrate serious interest in fiscal reform. Efforts to revise the tax system, manage healthcare spending, or reduce deficits have stalled. Without intervention, the debt trajectory may become unsustainable, undermining both economic resilience and global leadership. The issue extends beyond American borders. Even Japan, historically seen as a model of bond market stability, is beginning to experience volatility. Since 2019, its 30-year government bonds have lost 45% of their value amid rising yields. Some analysts believe the U.S. could face a similar reckoning, and possibly on a faster timeline. Lynn Alden characterizes the situation as a slow-burning fiscal crisis, rooted in years of policy missteps. The period of low interest rates, which helped governments mask the cost of growing debt, appears to be over. Now, as those rates rise, so do the challenges of managing the debt load. She attributes the crisis to a mix of expensive military campaigns, an aging population, and overpromised government programs such as Social Security. With fewer working Americans and a growing retired population, the financial strain is mounting. Even aggressive policy actions like steep spending cuts or major tax hikes may not resolve the issue, and could instead worsen the economic outlook by suppressing growth or triggering inflation. Trade dynamics add another layer of complexity. For over 5 decades, the U.S. has consistently imported more than it exported, a consequence of its role as the issuer of the global reserve currency. This arrangement once enabled a smooth recycling of dollars into U.S. assets. But over time, it has led to deindustrialization, the offshoring of jobs, and economic decline in many regions. Any attempt to correct this imbalance could disrupt the global supply of U.S. dollars, posing risks to the many nations whose debts are dollar-denominated. Reduced dollar availability could trigger international defaults and drive up interest rates worldwide. This creates a dilemma. To retain its reserve currency status, the U.S. must continue running trade and budget deficits, but doing so may undermine its own economic health. Alden questions whether the benefits of maintaining this role still justify the costs. At the same time, political dysfunction continues to thwart meaningful action. Despite rising debt, lawmakers from both major parties continue to prioritize short-term electoral gains over long-term stability. A clear example, under President Trump, Congress passed legislation projected to save $1.3 trillion, yet coupled it with $3.7 trillion in tax cuts, ultimately increasing the debt by $2.4 trillion. Neither side appears ready to make the difficult compromises needed for reform. Republicans favor tax reductions, Democrats push for expanded federal programs, both sidestepping the central issue of rising deficits. As interest payments consume a growing share of the federal budget, fewer resources remain for essentials such as education, infrastructure, and innovation. If these trends persist, confidence in the U.S. economy and its global leadership could erode significantly. The concerns raised by figures like Diamond and Alden are not speculative. They reflect tangible risks. If these warnings go unheeded, the consequences could extend far beyond financial markets, placing the nation's long-term stability at stake. Ultimately, the key question is whether there is still time to correct course, or whether the U.S. has already crossed a threshold from which return will be difficult, if not impossible. For those interested in learning more about investing, I've had a positive experience with Interactive Brokers. The link to their platform is in the first link of the video description. Now, if you're excited to see more content like this, don't forget to subscribe and turn on notifications.